Now, Warren Buffett is one of the greatest investors of our lifetime. He is known for his big company Berkshire Hathaway, and every year everybody is waiting for that annual letter, and I took hours, literally hours, to go through this letter and interpret what is important, what is not so important. So I summarized it in this video, so make sure to leave a like, and without further ado, we will jump right into it.
Wolf of Dubai.
Maybe you have $343,000 to spend on one stock. Now, then you can buy one Berkshire Hathaway stock. This is actually the stock price of one of the stock of Warren Buffett's company, because he never ever did one stock split with this company, and therefore since so many years, if we're just looking into the chart, since 1980s where it was at 320, it rose up to $350,000 per share. I mean, it was a quite nice ride since the 80s with 107,000% gain, an absolutely incredible return. And he have something to say always in his annual letters, how the economy is, how this company is, which decisions he make on investments, and therefore everybody is listening because such a wisdom is coming out of this mind. And his partner Charlie Munger, Warren Buffett itself, is 90 years old already, so much knowledge. He's one of the greatest value investors out there, and he made profit that nobody else could copy ever so far in terms of stock picking and stock investing. He was early investor in like Coca-Cola, for example, or Kraft Heinz, which made him billions of dollars, and he's always preaching the appreciation of value in companies, in management, in business ideas, in businesses. And therefore, let's jump into the shareholders annual letter and see what he has to say. So actually the first few sentences or text is actually against a new accounting rule from 2018, where companies have to now also put in their earnings the unrealized stock gains or stock losses inside the earnings. So this is actually something new in the accounting ruling. So companies were not forced to do that before, and now he said like this is ridiculous, and he actually, and also his partner Charlie Munger, doesn't agree with this rule because it makes so much instability, because as you know, stocks can go up and down and unrealized losses can go up and down. So in one quarter or 1 year you can have plus 20-30%, and just a couple of months later minus 20%, and then again plus 100%. So it's unpredictable, and you know, he just gave an example that previous year-over-year earnings and comparison to this new accounting rule came to a difference of 1,900%. So as you can imagine, and I totally agree with you here, Warren Buffett, that this sounds a bit of crazy. The next important part in his annual letter was actually about a book by Edgar Smith from 1924. Yeah, so a very old book, maybe almost 96 years old book, and this book is called Common Stocks as Long-Term Investments. Now this was by that time a little bit of clear and bold statement, very bold move by Edward Smith, because by then gentlemen, as Warren Buffett called them, invested rather in fixed debt interest government's bonds, which was a more safe investment. And by then the stocks actually was more, or had a more speculative flavor, which still is the case today, but even more back then when stock market, you know, just was still in the very earlies. However, he is comparing this to today, because this is actually very important later on towards the end of this video, because he is taking this example and he's emphasizing that actually companies are paying dividend to their investors, or if they pay dividend to their investors, they never pay 100% out of the profits back to their investors. So they keep something in the company which then accumulate and also compound. So the companies have compound interest and actually compound winnings and value that they are creating. And that's so the beauty about it, that Edgar Smith saw already in 1924, which others didn't saw. And that's why with time the book is actually more and more valuable. And Warren Buffett makes this nice analogies to this old years and this old centuries, which is beautiful, because you know, if you see some documentaries about Warren Buffett, he is still living a very simple life as a billionaire and one of the most richest guys in the world. The next part actually is about how they choose and what are the principles for Berkshire Hathaway to invest in companies and what happens if the company stagnates. So actually there's 3 principles: good returns on invested capital, honest and great management, and also a sensible price for the stock. And these are the 3 principles that they are doing their investments on at Berkshire Hathaway. And also he's showing off some holdings that they hold, and they are, you know, the biggest, some of the biggest companies in the world in their industries, like Apple, you know, and other big companies like Coca-Cola. Big leaders in their sectors are owned or partially owned by Berkshire Hathaway. Moreover, he's saying that, you know, there's companies that with time their growth stagnate, and these companies don't need to have more capital by Berkshire Hathaway, so they don't give them more capital, but there are also companies that always find a way to grow more. For example, Apple. And here he priced this kind of companies that, you know, they happily give them the money to make more out of it. And therefore that's the beauty about Warren Buffett and his team, that they always find these companies out there that really do well. So the next part is about their insurance business. And I don't know if you know, but Warren Buffett did something really intelligent. So he did the following. Once he gathered, you know, a couple of millions to invest for his company, he actually acquired insurance companies, because insurance companies sitting on a huge pile of cash that is only given out to clients or customers when they have a claim. And as we know, depending on a good risk assessment, then they know that actually they can bring a lot of value to this investment field, because Warren Buffett can use the premium that is paid by a client and then only has to put a little bit on the side for payments, for claims. And he said that his company structure about insurance is so structured that it's never, there's no possible claim that can take all the available cash flow out of the insurances. This is, you know, he structured it in this way. It always will be the case, and it will be the case. He ensured this, and this will never be compromised. In his words, you see that this is something very beautiful. And then he put a little bit story to that in 2012, one of his junior partners actually went out and purchased insurance company for around $200 million. And he said, like, these 2 guys at the insurance are really great people and can bring value to the company. And actually they was brought into the management of the company of Warren Buffett, and then, you know, decided to, you know, make some investments and made really well. And therefore, you know, Warren Buffett likes to bring some small stories on the side. So it's really beautiful to see the successful stories. And as we can see, insurance business is very important for them. Then we see the biggest investments of Berkshire Hathaway, and those are the companies like, for example, Apple, Coca-Cola, as you can see from the picture. And you can see that their investment got almost doubled from their original purchase price or average purchase price of this assets. And also we can see that the total common assets are at $2 148 billion. This is just the common stocks. To that comes also maybe some property, some bonds and other option calls and all these things that you have usually in a portfolio. Gold for sure. So, but this is only this common stocks and company holdings that they hold. And he said that whatever these companies are, they always have something in common, that they bring great returns. Actually, he throws some number here, 20% return on their working capital, and a very, very good view on no excessive debt for this kind of company. So really strong balance sheet. These are some other very important ways to look onto companies. So Warren Buffett looks at, okay, how much earnings, how much profit they actually make on the money that they need to operate the business, and how much debt they have. So if this the debt is low and the earnings are high on the capital that the company need, then this is a great investment according to Warren Buffett. Towards the end of the letter, he is saying, as always, anything can happen on the stock market. We can see moves even minus 50% of the overall, and he believes that something like this will happen in the future. He never know when, but he definitely say also that the overall picture, like low interest rate, low taxes in the US, will definitely make stocks the best investment vehicle. And also he's talking about the departure of Berkshire Hathaway, because he's talking about for himself and Charlie about the departure of the company, because they are just so old obviously, but they say they have a great successor team, and they will actually start to incorporate those successors in their very famous shareholder meetups that they will have soon. He's also very proud that his company paid approximately $3.6 billion income tax, which is 1.5% of all US income tax combined. So he's bringing 1.5% out of it just with his company. This is really, really great. And his next managers that will be joining the shareholder conference will be Ajit and Greg, and they will have more exposure to questions about by journalists. So let's jump into the conclusion. So even every year I'm reading this letter, I always learn something new. And Warren Buffett put something in his lifetime, in his 90 years on this planet, something that not everybody can copy that easily. And I'm really, really respecting his performance. It's just would be a dream to have this kind of performance for anybody on the stock market, obviously, And he always emphasized that it's actually, don't get scared out of the stock market. Hold holdings that if the stock market closed for 5 years, you would be comfy to hold this. Companies have less and less emotions or have no emotions at all during your investment periods. And he's emphasizing really very much in his overall letter that the conditions like low federal interest rate, where he also have no idea where it goes. He's not specialized in interest rate. And he said corporate taxes, what Trump inaugurated 2017 with going from 35% to 21% for corporations is a beauty. And together as a combination, stocks are really the number one assets that giving head start before any other asset class, and therefore we hope that the stocks can go further on if this combination stays the same before at one day for sure, as Warren Buffett says, we will have for sure a reset like we had the 2007 2008, and then it goes back up, because this is how we know the stock market, right?